The broadcast is now starting. All attendees are in listen-only mode.
Hi, everyone. Thank you for attending our webinar, Creating an Ownership Culture. We are ready to begin. Next slide, Corey.
It is not going down.
No, might be that delay. Here we go.
Okay.
I'm Virginia with Rutgers School of Management and Labor Relations, and I am your host and moderator. We encourage everybody to send us your questions throughout the webinar. I know it says here that we'll be taking questions at the end, but we will actually be taking them throughout the webinar. So what you'll do is click on the orange arrow that you see here in that picture. This opens and closes your controls. You'll type your questions into the question box and press send at any time. The webinar is being recorded, and a link to the recording will be sent to you by email, I would say, by the end of this week. It's now my pleasure to introduce our instructor. Corey Rosen is the founder and senior staff member of the National Center for Employee Ownership. Over the years, Corey has written, edited, or contributed to dozens of books, articles, and research papers on employee ownership. He's generally regarded as a leading expert on employee ownership and has appeared on numerous national radio and television news programs. Corey, please take it away.
Thank you very much. I really appreciate the opportunity to do this. And we're going to talk today about some of the lessons from employee ownership companies that hopefully will be useful to whatever kind of situation you are in. The practices of high involvement management, open book management, and similar efforts to get employees involved in sharing ideas. And that's really what makes corporations successful. I wonder if, as I'm talking, if people could just type in the chat area whether you have an employee ownership plan or not. That would give me a better idea of what the audience is like.
And actually, not the chat, the question and answer box.
Okay. So in the question and answer area, just say we're employee owned or we're not employee owned. So, what is an ownership culture? There are really, we think, four critical elements to ownership culture. The first is that companies share overall financial information with employees on a regular basis. So that doesn't necessarily mean that they're providing a 6-page income statement and a 4-page balance sheet, but they're providing the key metrics of how the company is doing on measures of revenue, profitability, cash flow, and assets. The second is that it's not just at this high level that they're sharing numbers. They're also creating and using metrics that we call critical numbers that are focused on the work level. So these are things like productivity measurements, quality control, output measurements, but usually most companies have a number of other critical measurements for each work group that really determine how well that team is performing. Third, they create a lot of employee teams, ad hoc work groups, cross-functional committees, and other ways that provide a structured, regular way for employees to share information and ideas. And finally, they devolve authority to the lowest possible level. And by the way, Virginia, I can't see if people are putting in.
You can't see it? Okay, we did get we received 3 responses, 2 employee-owned companies and 1 not employee-owned.
Okay. And the other 9 of you must be something. So if you're not one of those, if you could put in what you are, that would be very helpful. So why does it matter? Why do you even want to have an ownership culture? Don't you just want to really motivate people to make more effort, to work harder? Isn't it kind of intuitively the case that if people are more motivated, they'll make more effort and the company will make more money? And that seems obviously true, but it turns out to be at best trivially true. The math doesn't really work for this. So let's do a kind of thought experiment on this. The first question is to ask yourself, well, what percentage of our total costs are labor costs? And nationally, that's about 30%, although obviously that varies tremendously from one company to another. But let's just assume 30%. And the next question is, what percentage of our workforce would work harder if motivated? And you've got two groups of incorrigibles here. You obviously have the incorrigibly bad. These are people eventually you're going to probably fire. But you have a larger group in most companies, if you're a good company at all, of the incorrigibly good. And the incorrigibly good are only working as hard as they can, and extra motivation is going to be greatly appreciated by this group, but it's not going to change their behavior because they're already working as hard as they can. And research shows that these two groups of incorrigible constitute about half your workforce. And then the third question is, if they did work harder, how much harder would they work? What percentage of the total workday would be added by this extra motivation? When I've asked people around the country about that, people say, well, gee, if we could get another half an hour of effective work a day when, people aren't surfing the internet or whatever, that would be terrific. So let's multiply these out. 0.3 times 0.5 times 0.067, and we get about a 1% increase in performance. That's nice, but that's not game-changing. What is when you have not just people working harder, but people contributing ideas at all levels, small ideas to big ideas, on how the company can perform better. Great book on this is Ideas Are Free by Dean Schroeder and Alan Robinson. And that shows some of the research on this, but it also shows the why and, most importantly, the how. Lots of really good ideas on how to get ideas. So let's start with sharing the numbers. So income statements are really just the first step. So here's a sample, simple income statement for sharing with employees. And it tells employees that sales minus the cost of goods sold equals gross profit. And then we want to consider overhead, and that's our pre-tax profit. Now, you can go beyond this, and you probably should go into a little more depth on the income statement. But what's the importance of this? Well, first of all, it tells, obviously, people how the company's doing overall, making money or losing money. It's your scorecard. Jack Stack, who created the great game of business at SRC Holdings, Springfield Remanufacturing Company, when it started, one of the most successful businesses in the country. And Jack always says, imagine you are a basketball coach. You're the coach of the Golden State Warriors. And you've told your team, we're going to do something different. We're going to operate more like most businesses operate. So the scorecard, which is, of course, are we winning or losing this game, and all of the metrics that go beneath it, like field goal percentage and so on, those are actually secret. Those aren't things that employees should normally know or care about. So I'm not going to tell you. Now, how motivating do you think it would be for employees and basketball players not to know the score of the game, much less any of the other metrics? Not only would it not be very motivating, but But how are they going to learn to improve if only they know only the coach knows the number? Secondly, it has a really important symbolic value. If you are sharing these basic numbers with your employees, you're telling them you really care about them as partners in your effort. If you're not sharing those numbers, it's really difficult to get to that level of commitment. Of course, you want to go beyond, as in basketball or any other sport, you want to go beyond the mere did we win or did we lose, and how many games are we behind or ahead in the standings. You want to provide detailed operational measurements at each level of the company to look at how those particular work levels can be improved. It's important when you're sharing high-level information to explain the numbers in simple terms. Now, a lot of companies I've talked to initially about this say, oh, well, employees have a really hard time understanding these financial concepts. And I have to tell you, I've been doing this for 40 years now. I've been talking to employees. I've talked to thousands and thousands of employees at different companies. We've done lots of exercises on financial information, and that just isn't true. Some of the most sophisticated people that I've met about financials are line employees in manufacturing companies at open book management companies, because the companies made the effort to explain these numbers and how they work to people. Obviously, you want to put it in terms that people can understand. They're not accountants. But people deal with money all the time in their personal lives, and there's no reason why they can't deal with these basic numbers in their business lives as well. So if you don't go in assuming they can't do it, you're going to be surprised at how well they can. Now, these numbers should be shared in person. You can send out a document. I guarantee you hardly anybody's going to read it unless they're already really motivated. So have meetings. It is really effective if you can get not the CFO explaining the numbers, but alternate employees to explain the numbers, because you never learn anything as well as when you have to explain it to someone else. So if you can kind of alternate employees who've been coached by the CFO on the numbers, it's going to work a lot better. Okay, so critical numbers identify the performance levels at all levels. So the income statement is the score of the game, and the numbers are the statistics to measure performance. Now, most companies have a few critical numbers. These are the numbers that managers tend to worry about at night of how they're doing. Things like overhead absorption, customer satisfaction, return rates, defects, contributions to overhead and profits for sale contracts, new customers, customer retention, and many, many more. They'll vary from one company to another. But look at those numbers and make sure that you regularly communicate those numbers to employees. Now, the best companies don't do this from the top down. They actually do it from the bottom up, where they're working with employee groups. Ask them, what do you think our critical numbers are in your performance area? Because the people working at that level generally have the best sense of where the problems are. And you can divide critical numbers really into two separate buckets. One bucket is the things that we really need to do to make sure that we achieve our goals every year. The second bucket is, what problems are we having? What critical problems are we not looking at and resolving right now? So maybe this year your problem is that your retention rate has dropped, or your costs of overhead have increased, or your overtime is too high, or you're having too many work level accidents. And so you can make one of those a critical problem for the year that everybody really tries to focus on and come up with ideas about how to improve that. Once you've done that, you may find that that critical problem now gets resolved, and the next year you can move on to a different one.
Corey, we have 2 questions.
Please.
Okay, the first one is, we are an ESOP. We provide quarterly financial updates and explain what the numbers mean, but it seems not to make an impact. Any ideas how to fix this?
Well, the most important message, I think, from this webinar today is sharing the numbers is great. It's not in itself going to have an impact. It's part of a larger process. If that's what you do, but you don't do all the other things we're talking about, it's a nice symbolic thing. Don't expect it to change behavior on its own. I would suggest that you get people involved, play games around this. For instance, as an ESOP, you've got a valuation every year. Have your appraiser come and talk about the valuation, but before you do that, divide people into tables and have them guess the valuation for the year. And not just guess the number, but why. Why would it have gone up or down? Tell them what the financials are beforehand and say, what do you think happened to our valuation this year? Now they've thought about it. And once they've thought about it, it's going to be a lot easier when that message gets delivered to understand why that number is what it is. The most critical high-level number you can share in an ESOP company is what your stock price is, so take advantage of that. We have an exercise that we do called the Harry the Horse game, and that's a way to try to get employees involved in understanding valuation. It's in a publication we have called the ESOP Communications Sourcebook. It explains how that works and lots of other things about how to explain ESOPs. And what was the second question?
Okay, what are some strategies you can use as an employee-owned organization to get fellow owners excited, interested in the financial status of the company? Some individuals may just glaze over the numbers and do not care for accounting mumbo jumbo.
Right. Again, I think it's the same answer, that it's not just sharing the numbers isn't going to change people's behavior or get them excited. People get excited when they're using the numbers. It's also really critical that you relate these numbers to valuation. That's what the Harry the Horse game tries to do. Your income, technically your EBITDA, is the main driver of your valuation. And most employees have no idea what that relationship is or why that even exists. But if you make the effort to get them involved in understanding that, now that profit number becomes much more important, because every dollar in profit results in some multiple number of dollars in stock value. Most employees and most companies have no idea about that. So get people involved in trying to understand that. And the more you can do that through games and interactive kinds of activities, rather than just somebody standing up there and explaining it, the better off you're going to be. We don't have time in this webinar to talk about the specifics of those games and exercises. But as I said, they're in our communication source book. If you go to our conferences and webinars, we have lots more detail on that, or if you're a member, you can call us and I'd be happy to talk to you more about that. And we, by the way, we have our annual conference coming up not too far from you guys in Pittsburgh in April. So if you go there, you'll get panel after panel after panel of companies who are doing all these things, and you can learn from them. So the next step is get it employee information and ideas. So once they know the numbers, they have the basics of making better decisions, but now you need to get them involved in sharing ideas and information so that you can improve both efficiency, process, quality control, customer service, and effectiveness which is ideas on new products, services, and I also would add marketing. So how do you get there? For most companies, the answer is to encourage employees to share ideas. Sorry about the spelling error there. We really want you to tell us what you think. We have an open door policy, so come in and give me your ideas at any time. And I would bet you that not a single company in this webinar has a closed door policy. So saying you have an open door company is saying like you have a company. It doesn't add anything at all. And if you take away just one nugget from this webinar, it's that employee involvement doesn't happen because you allow it, even because you encourage it. It happens only because you structure it. So we're an open door company. As I said, sorry, so is everyone else. Nobody has closed door policies. Open door policies don't matter much. They're too ambiguous about, well, okay, boss says he has an open door policy, but when do I go in and how do I walk in the door? Is it really going to be kind of awkward to just do that? Open door policies provide no mechanism for sharing ideas with your colleagues. It's all go talk to the boss and hope the boss will like the idea and the boss will do something later. If you succeed, colleagues may resent your efforts and think you're apple polishing. If you succeed with a great idea, the boss may not follow up or take credit for the idea. It's just too ambiguous, it's too uncertain, and it just doesn't happen. If you do all the other things we're talking about, open door policies can actually work. But if that's your entire strategy, I can almost guarantee you, you're not going to get very far. Second common error that companies make on this is they say, well, we have an idea program. We don't want employees just carping about problems. I don't want somebody coming to me and saying, well, this is a big issue. And frankly, if you don't know what the solution is, don't bother me with the problem. And it's kind of like saying, if you smell the gas leaking, don't tell me unless you know how to turn it off. Identifying problems is really the critical element of an effective employee involvement problems. Once you know the problem, finding the solutions are a lot easier. But when you don't even address the right problem, solutions are really difficult to find. And sorry, this slide has a bunch of typos. I apologize for that. Proofing is not one of my skills, as you're finding out. So if open door policies don't work, how do you get ideas? And to get ideas, you need to structure collaborative efforts. So ideas sometimes come from individuals just thinking about things, but most ideas come from collaboration. We've all been in meetings when somebody says something and you think, now that you say that, that makes me think. And that phrase, that makes me think, is really the essence of what makes effective teams successful. It's a process by which people are encouraged to come up with ideas and, as I said, to identify problems. So every great employee ownership company focuses around teams, ad hoc committees, functional work groups. These will vary from one company to another. It depends a lot on your work structure. If you're an engineering company, for instance, you're already probably organized around project teams. So this is a pretty easy step to take, which is part of why there's so much employee ownership in engineering companies. Other companies may have functional teams, like a manufacturing company where people doing the same process are working on a team. But other companies find that they don't need a specific structure. They have ad hoc committees that get created to address particular issues. So for instance, it might be that there's a company-wide staff meeting, or if you're a big company, you have larger meetings, but from individual divisions of the company, and some problems get identified. And then the group says, okay, here's 6 problems that we need to work on. And so let's assign ad hoc committees of people to deal with each of those problems. And you have a kind of selective volunteering for that, where anybody can join that ad hoc team, but some people are assigned to it. So a lot of us may have ideas that we bring to these teams, but they're not really fully formed. And what the collaboration process ideally can do is create a mechanism by which these ideas get vetted, developed, and either tossed or moved forward. So some of the key issues with teams, teams don't need permission. One company I was involved with, for instance, was moving rapidly in the direction of employee involvement with enormous success as a result. And the new CEO, who used to be the CFO, was so delighted with the way things were going that he told people in the company, anything under $5,000, don't ask, just do it. And anything over $5,000, you should ask, but understand that I am almost certainly going to say yes, even if I disagree. I'm only going to say no if I think it's a really, really dangerous idea. That's the kind of permission that really tells employees that they can move forward. And those risks have proven to be worth taking in companies. It's important that the teams have a specific structure for what they're talking about and how they talk about it. Spend some time reading. There's lots of material out there, great books on how to build effective teams. And take a look at some of those. Dennis Concini's works are really very good. And learn about what makes effective teams and use some of those practices. One idea that I like is called problem busting committees. So what this is where you have a process where employees can fill out a form that says, here's a problem that I've identified. I don't necessarily know the solution, but I know it's a problem. That then goes to a steering committee. The steering committee says, oh, this is a no-brainer. Let's just do this to solve it. Or this is a really complicated issue, needs to go to management, or more likely says, let's form an ad hoc team to solve that problem. And once that problem is solved, the team dissolves. Kaizen events are another common team process where employees take apart the process step by step and rebuild it. So we can see some of the different kinds of teams on this slide. So why do they matter? As I said, it creates the aha moment, but it also creates a sense of common purpose. So it takes longer to make decisions, but once those decisions are made, implementation is easier. Obviously, you're sharing information and sharing ideas. Creativity, researchers tell us, flows from getting what's called the adjacent possible. So when you hear about something that's similar to what you're doing, but it's just different enough that it makes you think in a new way. And creativity is generally a function of bringing ideas from different areas to bear on a common problem. Good teams are also a lot more agile than traditional hierarchies, which tend to be very slow in processing information, making the decision quickly, but then slow again in getting people to make the changes that they've been told to make. Teams don't work just because you set them up. They can have a lack of clear objectives, a lack of authority, negativity bias. What this is the person who tends to say that won't work is often right. And because they're often right, people tend to think they're the smartest. And so you get this negativity bias. You may have, I used to tell employees, if you give me 10 ideas and 2 of them work, I'm much happier than if you only give me 1 idea and that 1 idea works. Because the 8 ideas that don't work are fairly easy to dismiss. The extra idea that does work could be a game changer. But if you're scoring 2 out of 10, it's pretty dismal. And so you can see where that negativity bias can come in. Groupthink, there can be a tendency to just go along with what the group wants and not challenge conventional wisdom on that. Lack of management support. There are, in fact, some things that are better done by individuals. You need to try to figure out what they are. You need to make sure you've got the right people on the team in terms of skills. People often say we're too busy. Good ideas save a lot more time and money, but because the savings of time and money occurs over a longer period of time, and meanwhile you're spending too many hours in meetings, you think it seems like a waste of time. And that disconnect between those 2 different time horizons can make people think that this is just a waste of time. But the most important factor, research has now shown, especially a huge project at Google, is a lack of psychological safety. And what that means is people don't feel comfortable sharing ideas and information. Google is very big on teams, and they've spent an enormous amount of money and research trying to find out what makes the teams most effective. And this is the one thing above everything else that distinguish good teams from bad teams. Good teams create an environment where people feel entirely safe in sharing ideas. So we can go through some of these more quickly. You clearly need clear objectives. So authority needs to be specifically defined. There need to be deadlines, and teams need to know what their responsibilities are. But once they've made a decision, do they have the authority to act? Does the team own its decisions? Is there a budget limit? Can management override it? Make these things clear. Ambiguity can kill involvement. The negativity bias I talked about. Groupthink, it's a particularly insidious problem because people can value preserving harmony above generating good ideas. So you can see here, it's a great example of groupthink at Penn State in the athletic scandal that they have, where the emails detailed in the report showed that this particular insider group managed to twist logic to the point where they thought it was more humane to cover up the reported allegation of Sandusky's abuse than report them to the police. So it can get really toxic if you start valuing group norms over good ideas. Psychological safety is what helps you get outside of groupthink, because now people feel safe to challenge it. Of course, lack of management support, low priority. Management says that we don't have enough time for this. You don't want to set up too many groups and all of that. And some jobs do need to be done by individuals. It's a specific task with specific skills. Teams need to have people with the right skills. So these can be technical, facilitation, problem solving, problem identifying. As I mentioned, the time horizon problem is very tricky because you don't see the benefits in as concrete terms as you see the time you spent generating them. And finally, as I mentioned, the biggest issue is lack of psychological safety. Let me stop there. Any questions before we go on?
We don't have any right now.
Okay. So let's say that you've now created an open book management company. You've got all sorts of teams. You've given them all kinds of authority. Your company's generating lots of new ideas. Hypertherm, for instance, a manufacturer of plasma cutting tools in New Hampshire, has 1,000 employees. It generates 3,000 ideas per year from employees that it actually implements. Imagine that, 3,000 ideas. Wouldn't that move your company forward? Well, you've created Hypertherm's culture in your company, and you're getting, you think, all these ideas. Is that likely to happen, and is it likely to be sustainable? Is a sense of ownership enough? And we just came past Thanksgiving, and we'll be moving on to Christmas, where we'll have nice dinners like these available to us. And I want to propose another thought experiment, that we invite you to have a sense of dinner. So you get to come to this elaborate feast, you get to smell the food, you get to help choose what to eat, make decisions on how to pay for it, how to clean up for it in the most efficient way, how to make sure that the food is safe to eat. You get to get involved in all of that great stuff, maybe even help cook it. You have a real sense of Thanksgiving dinner this year. But let's say that that's all you get is a sense of dinner. You don't actually get to eat. A sense of ownership is like a sense of dinner. It's a real turkey. If you ask people to think and act like owners, they may in fact like that at first. Gee, we're treating us better. They're treating us like our ideas really matter. But over time, people are going to become cynical because the benefits are mostly accruing to somebody else, not them. Research indicates that high involvement management systems do work well, but the problem is that they are much more likely to be terminated as management changes, as employees start to become resentful of the extra effort without extra reward. And finally, if you do share ownership, you have a much more legitimate reason to talk about why it's important to move the company forward. Yeah, you can do profit sharing, and that's helpful, but profit sharing is year to year. Ownership is the long term, and ownership is the only thing that really gets people with a financial focus on what happens over the long term. So sharing ownership, we've found, really does provide the glue that holds ownership, culture, behavior together. And this is an important concept. The general notion is that if you share ownership effectively with people, you give them a high percentage of their salary every year in ownership, your stock's doing well, that ownership will motivate people to create a culture of ownership. It's the other way around. Creating a culture of ownership makes people think and act like owners. Actually sharing ownership with people is the reward for doing that that makes these programs sustainable. Some years ago, we were asked to do a study of open book management companies, and we divided them into ESOP companies and non-ESOP companies. And we found for each group that open book management did improve performance, but there was a problem. We rapidly found over 100 ESOP companies with open book management who'd had that program for at least 3 years. That was what we required as a minimum for the study period. And then we needed to find non-ESOP companies who had open book management for at least 3 years and didn't become employee-owned during that process. And we really struggled to find companies that met that criteria. We talked to people with open book management groups. They identified a lot of companies, but the problem is that in most of those cases, they introduced these things with great fanfare. They worked really well for a while, but then something happened and they changed it. Or they decided that if we're doing this, we really should share ownership as well. So ownership matters.
Corey, we have a question.
Yes.
How do you preserve the team's psychological safety and not implement a majority of their ideas?
That's a really good question. And I think it's not dissimilar from our relationships with people in general. That when you're listening, there are a few things here. One is listen carefully and with intent to make sure that people understand that you really are trying to understand what their questions on concerns are. Secondly, it's almost always the case that no matter what somebody is suggesting, there's something about what they're suggesting that's important. Might not be that specific idea, but it might be that you can say, well, that's really interesting. You almost never say that, just say no. You can say, well, that's really interesting, that idea. Let's explore that. Maybe this particular take on it doesn't work, but what if we did it this way? Or let's get some other input on this and see if we can kind of tweak this. My colleague, Dallin Gazinski, who's very popular at our conferences, teaches a concept from improv, which is yes and. So you should always try to think about, when you're having these conversations, rather than yes but, say yes and. And he teaches companies to do these exercises where they go through different scenarios, starting out with yes but, and then everybody ends up being annoyed with one another, and change it to yes and, where you are saying yes and building on it, but maybe moving it in different directions. It's a remarkably effective exercise. And once you start doing it, we do it internally at the NCO, you start getting into that mindset of yes and it really starts to change things. And finally, there will be those occasions when it just really isn't a good idea. And you say, well, I really appreciate your suggesting that. Here's why it doesn't work. Now you've learned something. Hope the employees learn something. The next idea is probably going to be better. But you want to let them know that just because this one didn't work doesn't mean the next one doesn't work. And there are even some companies that provide rewards just for submitting ideas. So ownership cultures, I had a slide here about different forms of ownership, which we don't have time to go into, and I didn't want to really spend time on them in this webinar anyway. But if you go to our website at nceo.org, you'll see more about that. So ownership culture is not easy to implement. It takes a lot of work. It takes a lot of risk taking. It takes a lot of leaping off bridges to say, well, gee, I'm really nervous about letting people do this. And you're going to find people doing stuff you don't agree with, and sometimes it's not going to work out. And you have to have the fortitude to say it was worth doing because it honors the process, and they'll get better. We'll learn, we'll stop making mistakes. So it takes a lot of strength internally to make this happen. But if you go to our conference, some years ago, someone came to our conference who had gone to the conference of the National Association of Stock Plan Professionals. These are people who administer stock plans in public companies. And she said, those conferences are great, lots of good information and networking. I came to your conference, it's about the same size, lots of good information and networking. And it's like an evangelical tent meeting. All these people are so excited about their ownership cultures. And it's true. Once you get past that, you take that leap and you really get into this. As a manager, work is a lot more rewarding and interesting than it was before, and certainly is for your employees as well. So any last questions? I do want to just let you know, again, our website's nceo.org. We are a membership organization. We have about 3,400 members. We had about 1,800 people at our most recent conference. Next conference is in Pittsburgh in April. Hope you'll join us there. If you're not a member, we'd certainly encourage you to join. It's very inexpensive. Just go to nceo.org. We have lots of great resources on all sorts of technical and cultural issues. And Virginia, any last questions?
No, it doesn't look like we have any further questions. Thank you so much, Corey, for this great presentation. If anybody does have any additional questions that may come to you later, you can always send them to me and I can forward them over to Corey. Right, Corey? That's okay?
Absolutely.
So thank you again, Corey. Just want to let everybody know, save the date, our next webinar, Myth or Fiction, ESOPs Increase Employee and Sales Productivity. This is with Stephen White of Onyx Partners Group, and this will be January 17th at noon. So you'll be hearing from me shortly with information on this. And what's our next slide, Corey? Just information about the New Jersey, New York Center for Employee Ownership. Here we have our contact information, our executive director, associate director, and then of course my contact information. So this concludes our webinar for today. As I mentioned earlier, a link to the archive recording, I'm going to email that to everybody by the end of this week. We hope to see you in our future webinars, and for more information about the New Jersey, New York Center for Employee Ownership, our website is ownership.rutgers.edu. So thank you again, Corey, and thanks for everyone for joining us today.
Thank you.